ICICI TV18, celebrating 15 years of leadership.
Hello and welcome to Markets Today. I'm Lata Venkatesh and with me is Surabhi Upadhyay joining me from the Delhi News Centre. Well, Surabhi, here in Mumbai it was a very dreary day. Yet another day when volumes were abysmal and the indices did almost nothing. But well, we won't put it so badly. We will say the markets are looking for direction.
I suppose so. Hi, Lata. Yes, we were just talking about it yesterday. There's so much of action out of New Delhi with the government moving in top gear at the end of the year, even as the Lal Street gets into end of the year mode. Let's get through the top stories. A range-bound day of trade with the indices ending absolutely flat. The Nifty remains almost unchanged, closing around 8250. The Sensex gains just 8 points. Capital goods and power stocks see buying. Banks recover in the second half, but oil and gas and metal shares remain weak. Midcaps outperform with the midcap index rising 0.5%. Transformer company stocks like Schneider, Voltamp and Emco rally between 5 and 20% on hopes of fresh orders from Power Grid. Power Grid in turn rises on hopes of speedy clearances thanks to the land ordinance. Andhra Bank rises 5% on reports of recovering 200 crore rupees of NPAs. The rupee falls to fresh 2-week lows on global risk aversion and dollar strength, but recovers smartly on dollar selling by exporters who are booking quarter-end gains. Bond yields fall after the FM urges the RBI governor for a rate cut.
Well, those were the headlines, and here are the experts that we have lined up on the show for you today. Market perspective from Sanjay Dutt. The DIPV Secretary Amitabh Kant will talk about the macro picture after the Secretaries meeting India Inc. on Make in India. On Corporate Radar, we will have IDBI's Managing Director BK Batra, and we will also get you some corporate reactions to the land acquisition ordinance.
All right, all that coming your way over the next 30 minutes. But first, straight to the day's trading action. Yet another day of lackluster trade on the Lal Street as major indices clocked marginal gains on a day that saw very little volumes. Anuj is here with the day's trading highlights. Anuj?
Well, holiday mood still prevails on the Lal Street. Today again, the market with absolutely low volumes were in a tight band, and that's likely to continue up until the new year, and that's when the volumes would come back. In today's trade, banks did well, especially in the second half. Bank of Baroda, IndusInd, Axis Bank, HDFC Bank, some of these stocks did well, and the market had support from some heavyweights like L&T and Dr. Reddy's. But on the other hand, oil and gas and metals, they were down. So Reliance, ONGC, Kent, Tata Steel, Cesar Sterlite, all these stocks were down, and in the mid-cap basket, it was really a mixed bag. The top two traded stocks were both down actually, Unitech and JP Associates. But on the gaining side, you had stocks like Jacob and Adani Port. So really, it's all over the place right now. The trend for the market would emerge only in the first week of January. But as of now, the market is in a tight band, but the bias is still positive.
All right. Well, that's the bias in the market, but there were a couple of clear trends. The Adani twins did very well. Adani Ports and SEZ, as well as Adani Enterprises. Some expectation that the easier land acquisition norms may come of some use to these companies as well. You saw a lot of people dependent on wholesale markets, wholesale debt markets doing well. Bond yields actually fell rather sharply on expectations that a rate cut will come after the finance minister seemed to be pressuring the Reserve Bank governor. Yes Bank was one of the biggest gainers. LIC Housing Finance among the NBFCs was a big gainer. Typical gainers when bond yields fall. Well, that was the take on the mid-cap space. Surabhi?
Right, let's move then to some market perspective. Lata, now we caught up with Sanjay Dutt, director at Quantum Securities earlier in the day, and he's a contrarian. He is not very bullish on India going into 2015. In fact, he doesn't expect the fundamentals to change rapidly here on.
I don't think we'll make new highs. In fact, I will not be surprised if we don't make new highs in 2015 also. Because, you know, we've got to deal with our own problems, both in terms of macro issues, because today we're already seeing reality in terms of what the deficit is going to be like, what the revenue numbers are for the government, you know, what needs to be done in terms of implementation, what needs to be done in terms of corporate profitability and balance sheets. So to forecast that we'll see a 8,700 or 8,900, it looks difficult right now unless something radical happens in the next 6 months, which transforms. I think the only thing that I foresee that can happen is that very aggressive inflow of long-term money into Indian markets, opening the floodgates into various sectors where serious FDI money starts coming in, and that doesn't happen overnight. That takes time. Till that doesn't happen, balance sheets can't be set right. Till that doesn't happen, the inflows, the dollar rupee, those kind of equations cannot be set right. So therefore, I think 2015 in terms of a broader market is going to be a struggle.
Okay, so now that's a reality check from Sanjay Dutt. Let's get back to live markets and today's markets. All the action from the futures and action space from Varinder Bansal.
Clearly, if you're watching out for the options data, 8200, put was consistently seeing put writing, and that has been a theme since the last few days. 8500, 8600 call, there is some buying which is happening in. The premiums are going higher, clearly indicating you that for the market, 8200, 8250 remains the base, and on the higher side, 8400 is the one wall which you need to cross. There was a lot of interest actually which was in the mid-cap stocks today. Clearly, it was led by the Adani group stocks. Watch out for Adani Ports, that stock was up nearly 7.5%. Open interest zooming by 20% in that case. Even Adani Enterprise was up 4%. Open interest moving up by nearly 12% in that case. Entire banking pack was very active. If you're watching out for the private sector private banking stocks, Yes Bank was the one to watch out for. That stock was up nearly 3%. Open interest going up by nearly 15%. And the entire public sector banks, whether it was Andhra Bank, Syndicate Bank, UCO Bank, all were flying higher, anywhere between 2 to 4%. We were seeing long build-up happening over there. The entire transformers pack, was very active. And in the F&O market, it was Siemens, which is up nearly 2.8%. We were seeing long build-up happening over there. But few stocks which were in the red, clearly the high beta play, whether it was Unitech, JP Associates, those were down. Tisco, of course, was down because there was nothing which came on mining ordinance. And Hero Moto, which was down nearly 2%. Maybe, people had a hint that the excise may not get rolled over. And that stock was down 2%. We were seeing fresh shorts over there.
All right, Varinder, thanks so much for that. Let's actually take this forward. Varinder has been talking about some of these stocks from the power and the capital goods space that have been so active in the futures and options market. It is sectors like power and housing which are expected to be the biggest beneficiaries from the government's land acquisition ordinance, which was moved yesterday. Pragya Bharadwaj is now joining in. She's been tracking what the movement is on ground, what the expectations are on ground. Pragya, how does it look?
Well, one common theme that has emerged from all of the notes that have come out today is that, yes, the compensation and the resettlement and the rehabilitation clauses remain extremely high, quite elevated for the corporate India. But what is definitely quite positive is things will be a lot swifter. Land acquisition will have a lot more definitive timelines. So something that is less than about 10% of the overall project cost, corporate India will have to spend a lot less time in dealing with that overall issue. Whole host of sectors will actually be beneficiaries of this. So I'll pick out some pockets for you. One being the fact that the companies that have in past partnered with the government on various PPP projects, and these could be companies like L&T or some of these big conglomerates like GMR, Adani. Those companies would be big beneficiaries of this. The other trust area of the government that came out from the press conference yesterday was there will be a lot of flurry of activity that we will see now pick up in the industrial corridor space, and especially a lot of the land acquisition will move a lot faster. So companies that have exposure to the dedicated freight corridor, the Delhi-Mumbai industrial corridor, so companies like L&T, which are L1 in a lot of orders, companies like Concord that have very intense logistics, multimodal transport business models will benefit out of this. A lot of the logistics companies will also be key beneficiaries, indirect beneficiaries, and there will be transportation and movement of traffic from road to now rail. So companies like Gati, Gateway District Parks, etc. The boom in the real estate construction that we will see will help a lot of real estate developers, but will also provide a fillip to the EPC side of business for a lot of the infra companies that are involved in the building construction business. So names like Jaykumar Infra, Simplex Infra, NCC, Ahluwalia Contracts, and L&T. Of course, things stay same for Power Grid. The company's right-of-way becomes a lot more smoother, but this is something that had come by in the land acquisition bill last year as well. And finally, road companies will see some sentiment positive as NHAI will now have a lot more power in overall acquiring the land. So the bidding of the projects will be a lot faster and a lot more surety for a lot of these players when they go ahead for some of these projects. So a whole host of sectors will be key beneficiaries of this, and we've clearly seen that play out in the stock prices of some of these companies. Back to you.
All right, thanks for that, Pragya. Let's, in that context, hear and listen in to Mr. Arun Nanda of Mahindra Lifespace.
I don't think it's going to give a boost to the real estate sector because I don't think that's the intention. The boost will only come for affordable housing. Welcome move. I think it takes interest of the farmers because they are going to be protected from the compensation part of it. But the irritable processes will be removed for certain segments of the industry is what I read.
Well, we told you first, and now it's official. IDBI is set to sell its stake in Care Ratings and has already received board approval for this. In fact, speaking to CNBC TV 18, the IDBI management said that the timing for the stake monetization is right. Listen in.
Today the market is doing well. Care is doing well. So timing seems to be right to monetize some of this shareholding that we have been having. We have decided to go in for either a portion or the whole of the shareholding that we are having for sale. If we happen to sell the entire stake, then going by the current price, I think the amount could be somewhere between 600 to 700 crore.
Well, CNBC learned from sources that PE investors have already lined up for the stake sale. Kritika Saxena has these exclusive details. Kritika.
Absolutely. Now remember, IDBI holds around 16% roughly in Care Ratings and Canara Bank holds around 11%. IDBI has been looking at selling stake from quite some time. We had reported in November that they are likely to revise their plans to sell their stake, and so will a couple of other investors, including Canara Bank. Now, IDBI has yesterday said that the board has given an approval to sell stake. There hasn't been any official confirmation from Canara Bank yet, but we do understand that together they are likely to sell stake. So, of course, together that stake does come up to above 25%, and that takes the overall shareholding to a level where the deal could trigger an open offer. Now, our sources say that they're likely to sell the stake through a closed bidding process, and players like Bearing Private Equity Asia, Christ Capital, and Actis are likely to have actively looked at this. Even Blackstone, according to my sources, is exploring options, and in fact, they may even be open to investing a majority stake. But I do understand that the investors are preferring to sell this to a strategic player. So the conversations will go on. The deal is likely to be done through a formal closed bidding process, which will happen around Jan. So we should wait for that. Remember, the reason why IDBI was unable to sell stake in Care Ratings earlier was because of the price. Earlier, they were expecting at least 800 to 900 rupees per share. And, at that time, it was difficult for PE players to invest that much. But the levels right now are above 1400 rupees per share. And at this price, yes, PE players are concerned, but let's wait and watch out. Care definitely has outdone itself in terms of the stock performance, and it has become a meatier company than last year to invest in. So this time around, they could be lucky.
All right, Kritika, thanks so much for that. Let's move on to some news coming in. The government, which is, of course, under quite a bit of fiscal pressure, might be removing the reduced excise duty benefits for automakers, and these might not be extended after they expire on the 31st of December. This could prompt car makers to increase prices in the new year. Farah Bukwala Vora is now joining in to explain the impact. Farah, we know that the auto sector has enjoyed this excise respite in order to boost manufacturing as we were coming out of the slump. What is it that you're learning now?
Well, Surbhi, before we go back and, we discuss what the impact could be, let me first take you through, what kind of an excise duty cut we had seen during the interim budget this year. So if you see, we've seen that, excise duty had been reduced by about 4% on small cars, scooters, motorcycles and CVs. We've seen it go down by about another 4% on mid-sized cars. Large cars had seen it go down by about 3%, and SUVs had seen it go down by 6%. And of course, the auto sector did enjoy the benefits of that reduced excise duty. Now, what could be the possible impact of the duties not being extended beyond 1st of January? Analysts tell us that prices could go up anywhere between 8,000 to 20,000 rupees. And what could be the impact of that? Now, we're getting two very contrarian views here. The first view that we are getting is that this could have a disastrous impact, particularly because the auto sector is not out of the woods, and this would definitely have an impact on the entry-level segment where customers are extremely
extremely price sensitive. Now, the other view that we are getting, in this particular case is that it will not impact the sales of cars at all, given that the market is currently only seeing very, very serious buyers, and any kind of price impact is unlikely to deter them from making any purchases. Analysts are also saying that, it is important to look at this from a slightly long-term point of view. The next 6 to 12 months will be crucial because you will see the confluence of several positive developments coming together. The easing of inflation could see interest rates drop, and that could positively impact EMIs. We are also going to see the implementation of the 7th Pay Commission, and the overall consumer confidence could also improve. So it could put a lot more money into the hands of consumers. Auto companies on their part could be passing on the benefits of lower crude and commodity prices to consumers. So all of this will bode well for the auto sector, and definitely if there is any marginal impact as well, it would be negated.
All right, thanks a lot for that, Farah. It's the turn of this new year, and we are getting you an expert voice on what you can pick up next year. Basant Maheshwari, founder of the Equity Desk and author of The Thoughtful Investor, expects the next bull market to be led by housing finance companies. Listen in.
If you ever bought a sector leader in the Indian market, it was a challenge to have lost money. Had you bought ACC in 1992, in spite of all the Harshad Mehta boom, you would not have lost money. You would have recovered it back. Had you bought Infosys in 2000, you would have got your money back. Had you bought, say, L&T in 2007, so Nagarjuna Construction is still 80% below its highs, but L&T you still get your money back. So irrespective of what you do, if you can just focus in life that I'm just going to buy sector leaders, you'll do well. Every bull market has to have a leader. You can't have a bull market with 100 stocks leading the market. There has to be a select few. So if 1992 was cement and steel, in 2000 it was software led by Infosys, in 2007 it was real estate and infrastructure led by Unitech and L&T. It's too early to make that call. I think this time the bull market could well be led by housing finance companies.
All right, ideas for 2015. Time for a break now, but coming up, an excerpt of our conversation with the DIPP secretary, and we'll also be getting you some trading ideas.
CNBC TV 18, celebrating 15 years of leadership.